Every time you place a trade in your investment account, meaning buying or selling something like a stock or an index fund, you have to select an order type for that transaction. In most cases, you can choose from one of three options: market order, limit order, or stop order, with some subtypes underneath each one. When I first started investing, I had no idea what to pick. So I asked a friend who I knew dabbled in the stock market, and they said to just use market order. So that's what I did for many years without really understanding why, or if there was a better option available that I wasn't using. Well, today's video is on what I should have learned back when I was 18 and bought my very first stock. Whether you're a newbie investor or, like me, have been investing for years without really understanding what the different stock order types mean, this video is for you. The first thing to understand is that the stock order type that you select every time you buy or sell different securities will determine the way in which that transaction occurs. Do you want to buy or sell instantly at the end of a stock market day, once a certain price is reached, or when a certain event happens? The stock order type that you choose has more of an impact when you make lots of really frequent trades, especially with individual stocks that are very volatile, meaning that they fluctuate in price very rapidly. If you're a day trader making dozens of trades every day, the way in which those trades are fulfilled, which is determined by the stock order type that you select, can have a pretty big impact on your investment returns, because day traders rely pretty heavily on precise timing of the market. On the other hand, if you're an index fund investor just chucking away money for retirement, the stock order type that you select will have less of an impact because of two reasons. First, you're investing in index funds, which tend to experience fewer day-to-day price fluctuations than individual stocks. And secondly, your investment horizon is much further in the future, meaning that the way in which your transactions occur will have less of an impact over the performance of your portfolio in the long run. Regardless of what kind of investor you are, however, knowledge is powerful, so it's still really important to understand how your investment transactions are being fulfilled in the stock market. The simplest and most common stock order type is called a market order. A market order simply says to fulfill the transaction at the current price as soon as possible, and depending on what you're trading, that's generally pretty instantaneously, assuming that the stock market is open, which in the US is between the hours of 9:30 a.m. and 4 p.m. Monday through Friday, excluding holidays. If you're initiating the transaction outside of stock market hours, it will be fulfilled at the very beginning of the next market day, hence the name market order. However, even if you initiate the market order while the stock market is open, the price that you see when you submit your transaction might be slightly different than the price you ultimately get, and the reason comes down to supply and demand. Because we're dealing with virtual numbers on a screen, it's sometimes really easy to forget that there is a limited quantity of shares out there for a given security. Take Apple for instance, ticker symbol AAPL. It currently has 16 billion shares out in the stock market owned by shareholders, also called the number of shares outstanding. Let's say you're one of these shareholders and you initiate a market order to sell one share of Apple for the current price, which at the time of the transaction is showing as $142. You have to go find a buyer who's willing to buy that share of Apple for the current price. Between 50 and 100 million shares of Apple are traded each day, so it's extremely likely that you'll find a buyer out there who's willing to buy Apple at the current price. This process is made exceedingly simple by trading softwares that match buyer and seller in a matter of seconds. But let's say hypothetically that your trading platform can't find a buyer who's willing to buy your Apple share at the current price. A few minutes go by and then the value of Apple shares goes down to $141. And then and only then the buyer raises their hand and says, yes, I'm willing to buy Apple for $141. Your market order will then execute with this buyer because you told it to sell at the current market price, not necessarily an exact dollar amount. And because there can sometimes be this lag time between matching a seller and a buyer, you submitted your transaction thinking that you'd get $142 for your Apple share. But when you go back and look at your transaction history, you see that you only received $141. A market order simply guarantees that the transaction will execute. If you're selling a security, a sell market order sells to the first willing buyer. And then conversely, if you're buying a security, a buy market order buys from the first willing seller. The difference in price between what a seller is willing to sell at and what a buyer is willing to buy at, also called the bid-ask spread, is what can sometimes cause changes in the expected transaction value. I used Apple in this example, but this is extremely unlikely to ever happen with Apple or any other high-volume stocks or ETFs, at least not for more than fractions of a penny. And high volume just means securities that are big enough to be traded very frequently, like at the amount of millions of shares every day. You're also less likely to experience large bid-ask spreads if you initiate the transaction during open market hours, as stocks can sometimes experience larger fluctuations outside of these hours, which won't be visible until the next stock market open. Before submitting a market order, it's usually a good idea to check the daily trading volume for that security, which you can do by typing in the ticker symbol into Google, navigating to your favorite finance website, and looking it up. Right here on Google Finance, it has the stat on the very front page, average volume. If you're trading a lower volume stock, or you just want to be absolutely certain you know exactly what dollar amount that transaction will execute at, you can use something called a limit order. A limit order functions similarly to a market order, but as the name implies, adds a limit to the order so that you don't go over or under a certain amount. Take the Apple example again. If you wanted to sell your Apple share for exactly $142, you could set a sell limit order for $142. If Apple's market value drops to $141 or even lower before you're able to find a willing buyer, you'll hold on to your Apple share until the value recovers, however long that takes. And you don't have to set the limit order to the current market price. You can set it to be whatever you want. Say, for instance, that you don't mind holding onto your Apple share, but you'd be willing to sell it if the value of the share went up to $150. You could set up a sell limit order and it would execute if and only if it finds a willing buyer at that price or higher. The reverse example is called a buy limit order. If you wanted to buy an Apple share, but you weren't willing to pay more than $130 for it, you could submit a buy limit order for $130, and that transaction would automatically execute if and only if your trading platform found a seller who was willing to part with their Apple share for $130. Or in other words, the market value of Apple dropped to $130. The great thing about limit orders is that if you have a very specific execution amount in mind, you don't have to sit in front of your computer watching the stock market like a hawk until the value either increases or decreases to the amount that you want. Your investing platform just does that for you. A word of caution about limit orders: there's no guarantee that they will execute. If a stock never rises or falls to your designated amount, that transaction will just never happen. There are two subtypes of limit orders: day limit orders and good-till-cancelled limit orders. Day limit orders just mean that the limit order is only valid for the remainder of the stock market day, and if the value of that stock never reaches or falls to your limit amount, then that transaction just never happens and it's deleted. Good-till-cancelled limit orders, on the other hand, stay active day after day, just waiting to execute until the criteria is met. Each trading platform is different, but most platforms keep good-till-cancelled orders active for 60 days. And of course, like the name suggests, good-till-cancelled orders can be canceled at any time if you change your mind before execution happens. And remember too, even if the stock price rises or falls to your limit amount, it may not actually be fulfilled. Transactions are typically fulfilled on a first-come, first-served basis. So if other investors submitted limit orders for the same amount before you, their transactions will be fulfilled first, and the stock price might rise or fall in the opposite direction before your order can ultimately be fulfilled. If you're a set it and forget it kind of investor, limit orders might not be the best option if you don't have the discipline or the desire to go back a few days later or however long it takes to check that your order ultimately went through. The third very common stock order type is called a stop order. They are functionally very similar to limit orders in a lot of ways, just sort of opposite. Using the same Apple example from before, let's say that the current stock price is $142. If you have a limit order for $150, that just tells your investing platform to sell your Apple share if the value reaches $150. But a stop order looks the opposite direction. What if instead of rising in value, the stock price actually falls? If you have a stop order transaction for $130, your shares of Apple would be sold if the stock price of Apple hits or drops below that $130 threshold. This example is often called a stop loss transaction because you're stopping a large loss from occurring. The idea being that the assumption is that the stock would continue to fall in price and you're selling off your shares before too much loss has occurred. Where stop orders differ functionally from limit orders, aside from what direction they're looking at, is how those orders are ultimately executed. With a limit order, the transaction will execute at your desired price, not a penny more or penny less. With a stop loss order though, Your transaction will execute like a market order once the designated stop threshold has been reached, meaning that it sells at the current market value, which may be lower than your stop threshold by the time you find a willing buyer, especially if the value of the stock is dropping rapidly. There is a type of stop order that addresses this issue called a stop limit order. A stop limit order means that once the stop threshold has been reached, the transaction will execute like a limit order at the designated amount that you predetermine. For example, let's say that you submit a stop limit order to sell your Apple shares at $130 with a limit of $129. If the stock price of Apple falls to $130, your limit order will then be executed. But you will not sell your Apple shares if you're not able to find a willing buyer before the stock price drops below $129. If both of these conditions are not met, then the transaction will not go through and you will hold on to your shares. Of course, while this guarantees that you won't sell your shares for anything less than exactly what you want, this comes with the risk that the value of the stock just continues to drop further and further, devaluing the shares that you're holding on to. Stop orders, while typically used for selling transactions, can also be used for buying. For example, you could submit a buy stop order if you want to buy shares of a certain stock that you think might increase rapidly and you don't want to miss out on buying into that stock before it gets really expensive. And it's important to call out that all of my examples have involved only transacting one share at a time. But in all likelihood, you'll probably be transacting multiple shares at once. And in limit and stop limit orders where the execution is not guaranteed, it's entirely possible that only part of your order is ultimately fulfilled. And one other thing to note, if you're trading mutual funds, your stock order type does not matter. In fact, your investing platform probably won't even let you pick an order type for mutual fund transactions. And this is because mutual fund transactions are always executed at the end of the stock market day after it closes at 4 p.m., regardless of when you initiate those transactions. For a better understanding on the differences between mutual funds, index funds, and ETFs, check out my other video on exactly this topic. If you learned something from this video, please consider giving it a thumbs up and leave a comment. If you're new here and you want to learn more about investing and the stock market and a whole bunch of other financial topics, consider subscribing. Thanks for watching, and I'll see you all next week.